The financial markets are not a level playing field. If you have ever felt like an invisible force is hunting your stop loss, or if you have watched price reverse the exact second you entered a trade, you aren't paranoid. You are simply on the wrong side of liquidity. Most traders spend years mastering retail patterns, head and shoulders, trend lines, and RSI divergences, only to realize they're providing the very exit liquidity the smart money needs. In 2026, these retail methods are more than just outdated. They're targets. Welcome to Profit Logic Global. Today, we're stripping away the noise. We're moving beyond the indicators and the guesswork. I am going to reveal the only trading framework that matters this year, the smart money concept. This is not just a strategy, it is a lens through which you see the true intent of institutional players. By the end of this session, you will understand why the 90% fail and how you can join the 10% who follow the footprint of the giants. Let's start with a hard truth. Have you ever wondered why a perfect support level breaks, triggers your stop, and then immediately rockets in your intended direction? That's not a mistake. That is a hunt. The institutions, central banks, hedge funds, and Tier 1 banks cannot just click a button and enter a billion-dollar position. They need liquidity. They need thousands of retail sell orders to fill their massive buy orders. To find that liquidity, they must drive price into the areas where your stop losses are resting. To trade like the smart money, you must first master the 4 pillars of the institutional framework: market structure, liquidity, order blocks, and fair value gaps. The first pillar is market structure. This is your compass. Without it, you are lost in the volatility. Most traders get distracted by small movements, but you must focus on the swing highs and swing lows. In a bullish market, price must create higher highs and higher lows. The moment a previous swing low is breached, we have what is called a change of character, or cho-cho. This is the first warning sign that the trend is shifting, but a warning is not an entry. We wait for the break of structure, or BOS, to confirm that the new trend has legs. Are you watching the candle closes, or are you being fooled by the wicks? Remember, wicks hunt liquidity, but bodies respect structure. The second pillar is liquidity, the fuel for the market move. Think of liquidity as money left on the table. There are 2 primary types you need to identify: buy-side liquidity, resting above old highs, and sell-side liquidity, resting below old lows. When you see equal highs or double bottoms, retail logic tells you it's a strong level. Smart money logic tells you it's a massive pool of stop losses waiting to be harvested. Before a major move happens, the market almost always sweeps this liquidity. Have you identified where the dumb money is hiding their stops today? If you can't find the liquidity in the market, you are the liquidity. The third pillar is the order block. This is where the institutions actually leave their footprints. An order block is the final candle of the opposite direction before a massive impulsive move. For example, in a bullish scenario, it's the last bearish candle before price explodes upward, breaking market structure. This candle represents institutional selling to lure in retail traders before they reverse the market with overwhelming buy volume. When price eventually returns to this block, the institutions are often mitigating their previous losses or adding to their positions. This is your point of interest. This is where we wait. Finally, we look for the fair value gap, or FVG. This occurs when price moves so quickly that it creates a structural imbalance, a hole in the price action where only one side of the market was filled. These gaps act like magnets. The market has an inherent need to return to these areas to balance the price. When you see an impulsive move that leaves an FVG and breaks structure simultaneously, you have found a high probability setup. Imagine this scenario. Price sweeps a major daily low, liquidity grab, then aggressively moves up, breaking the previous high, change of character. In that aggressive move, it leaves behind an FVG and a clear order block. Now you aren't chasing the price, you are the predator. You are waiting for price to calmly retrace back into that FVG or order block. That is where you strike. Do you see the difference? A retail trader sees a breakout and buys the top out of FOMO. A smart money trader sees the breakout as a signal of intent and waits for the discount. We don't trade what we feel, we trade what the banks reveal. This requires a level of discipline that most people simply do not possess. Are you willing to sit on your hands for hours or even days waiting for the market to come to your zone? The 90% win rate doesn't come from a magic indicator. It comes from the confluence of these factors. When the market structure, liquidity, and the order block all align, the probability of success is overwhelmingly in your favor. But even with the best strategy, the market will test your resolve. It will try to shake you out. This is why understanding the why behind the move is more important than the how. Stop looking for shortcuts. Stop looking for the next holy grail indicator. The only holy grail is understanding the supply and demand created by those who actually move the needle. You must train your eyes to see the traps. Every time you look at a chart, ask yourself, where is the liquidity? Who is trapped right now? Where would the institutions want to buy at a discount? In the next stage of this masterclass, we will dive deeper into the precise entry techniques and the psychological warfare you must win to execute this strategy flawlessly. We will discuss how to manage your risk so that even a rare loss doesn't derail your journey to 2026 profitability. Stay focused. The shift from a retail mindset to an institutional mindset is the hardest trade you will ever make, but it is the only one that pays. Building on that foundation, let us discuss the precision of the entry. Identifying a zone is only half the battle. The execution is where the amateur and the professional diverge. To achieve that 90% win rate, you must refine your entry on a lower time frame. If you identify an order block on the 4-hour chart, you do not simply set a limit order and walk away. You drop down to the 15-minute or even the 5-minute chart. You are looking for a market structure shift within your higher time frame zone. This is what we call fractal alignment. When the microstructure matches the macro trend, you have found the sweet spot. Why is this lower time frame confirmation so critical? Because it allows you to tighten your stop loss. While a retail trader might risk 50 pips to gain 100, a smart money practitioner can often risk 5 to 10 pips for the same target. This isn't just about being right, it's about your risk to reward ratio. When you can consistently achieve a 1 to 5 or 1 to 10 ratio, you no longer fear a losing trade. In fact, you could lose 5 trades in a row and still be significantly profitable with just one winner. Does your current strategy give you that kind of mathematical edge, or are you one bad trade away from blowing your account? Let's talk about the fair value gap once more. Many traders make the mistake of thinking every gap must be filled immediately. This is a trap. An FVG is only high probability when it is coupled with a displacement move. If the market is slowly drifting into a gap, it is likely not institutional. We want to see speed. We want to see the institutions leaving the retail crowd behind, creating a vacuum that price eventually must return to. Think of it as an elastic band being stretched. The further it goes with momentum, the more violent the snapback to the fair value will be. Now, we must address the hardest part of the smart money concept: patience. The market is designed to trigger your impulsiveness. It will create inducement, mini structures that look like order blocks but are actually just more liquidity. If you enter too early, you become the stop-loss hunt for the real move. You must ask yourself, is this the actual bottom, or is there a pool of liquidity just a few pips below this level that hasn't been touched yet? If the answer is the latter, stay away. The smart money is patient. They are the predators, not the prey. As we move through 2026, the algorithms are becoming more sophisticated, but the core human psychology behind the institutions remains the same. They will always need to buy low and sell high. They will always need to trigger your fear to get their orders filled. Your job is to remain clinical. Emotional trading is retail trading. A mentor doesn't trade based on hope. A mentor trades based on evidence. As we conclude this session, look at your charts. Remove the colorful indicators that lag behind the price. Look at the raw candles. Can you see the footprints? Can you see the manipulation? This strategy requires you to unlearn everything the retail gurus told you. It requires a complete ego death. You are not here to predict the market. You are here to follow the money. This is the Profit Logic Global. We don't chase green candles, and we don't fear red ones. We wait for the trap, and then we join the hunters. If you are tired of being the liquidity, it is time to change your perspective. Your next move is simple. Go back to your charts and find 10 examples of a liquidity sweep followed by a break of structure. Do not trade yet, just observe. See how the market respects these laws. Once you see it, you can never unsee it. If this deep dive challenged your perspective and you're ready to stop being the target, hit the subscribe button and turn on notifications. We are here to dismantle the retail myths and build institutional masters. This is 2026 and the game has changed. Are you coming with us or are you staying behind as exit liquidity? The choice is yours. Trade with logic, trade with the smart money. I will see you in the next session.